It is the expectation of the committee that fiscal consolidation will take hold gradually, and the mid-year budget review will provide further fiscal fine-tuning to ensure that the fiscal consolidation efforts stay on track. Despite the improvement in the trade balance due to favorable commodity prices, the external sector has weakened somewhat due to developments in the capital and financial account. The domestic economy does not fully benefit from higher oil and gold prices due to retention agreements in these sectors. The increased repatriation from dividend payments and profits, as well as the net portfolio reversals, have resulted in a widened balance of payments outed and loss of reserves. The prevailing tight global financing conditions and further policy rate hikes in advanced economies continue to pose risks to the external outlook. Headline inflation surged in April 2022, and both headline and core inflation have stretched further above the upper limit of the bank's medium-term target band. The heightened uncertainty surrounding the inflation dynamics has weighed heavily on the domestic environment and significantly depressed business and consumer sentiments. The inflation numbers show that while food inflation has accounted for the increases in inflation over the past year, the recent jump in April shows that relative price increases in the non-food sector is accelerating at a fast pace, which provides information on the extent to which prices are becoming embedded. The bank's latest forecast shows a continued elevated inflation profile in the near term, with a prolonged horizon for inflation to return to the target band. Inflation expectations by consumers, businesses, and the banking sector have also heightened. The risks to inflation outlook are on the upside and emanate from the availability of inputs for food production, imported inflation, continued upward adjustments in export petroleum prices and transportation costs, possible increases in utility tariffs, and potential wage pressures. The second round effects of these administered price adjustments would further amplify inflation pressures in the outlook. These considerations show that with strong rebound in growth and the closing of the negative, the balance of risk is clearly on inflation. The MPC took the view that it needed to decisively address the current inflationary pressures to re-anchor expectations and help foster macroeconomic stability. On the basis of the above assessment, the committee decided to raise the policy rate by 200 basis points to 19%.
From our end, we are a bit disappointed with the increment, because our initial analysis on the sources of inflation clearly indicates where it's coming from, and that is the supply side constraint. So we made it clear, of which we also communicated to the central bank, that it may not be appropriate to immediately increase the policy rate, but to look at other supply side constraints and how we can incentivize the private sector to produce more, so especially from the food side. So we were actually not expecting an increment at this stage, but it has happened. But cumulatively, for the past 2 months, you realize that there have been over 4.5% increase in policy rates, and that's put a lot of pressure on businesses as well. Anytime the policy rate goes up, a lot of things happened, and the effect is largely felt by the private sector. They have their opinion, but we are also talking from the real sector and from the perspective of the private sector. One, the interest rate is likely to go up. Even with the initial increment, of 2.5% in March, we have witnessed an increase in interest rates. And the pass-through is not fully yet. We are expecting that it will increase further. So with that further increase in 200 basis points or 2%, we are expecting a very huge increase in interest rates, and that will affect the cost of production of businesses. The other effect also is the possibility of the high rates of the crowding out of the private sector. Anytime there is an increase in the monetary policy rate, the treasury bill rate also goes up significantly. So with a 4.5% increase to 19%, we are expecting that the treasury bill rate will also go up. And we have a trend where anytime the treasury bill rate goes up, you get the banks, instead of lending to the private sector, prefer to give money to the central bank or
And thanks for staying with us on the AM show. Now, we know that the Monetary Policy Committee of the Bank of Ghana has, for the second consecutive time, increased the policy rate, the rate at which it lends to commercial banks, by some 200 basis points to 19%. Now, the increase in the central bank's monetary policy rates means, obviously, that the cost of borrowing is expected to go up at least for the next 2.5 months. So how will this affect the ordinary Ghanaian? That's also on our focus today here on the AM show. Let's speak to Professor John Gatchius, the Dean of the UCC Business School. Thank you so much, Prof, for joining us this morning. So we weren't expecting it, but it's been announced. So what's the implication for businesses and, in fact, the economy as a whole?
Well, a lot of implications. First, as we know, the cost of borrowing is expected to go up. And when that happens, there are possibilities surrounding that expectation. One, there is that likelihood of potential default, because when the interest cost goes above a certain point for businesses, for individuals, repayment becomes a challenge. So the banking sector and the financial sector will be more strict relating to their credit policy, how to follow up on businesses and individuals who have borrowed from the banks. So that will happen. Then again, there will be cost increases across board, because when the lending rate goes up, typically it's a cost to businesses. And that will affect government also. Government has a number of projects, supply contracts and the rest at a particular price relating to inflation, at a particular price relating to cost of borrowing. But now that cost of borrowing has gone up, mobilization of funds by contractors and suppliers will become difficult. There will be delay in supply procurement for projects. There will be delay of project execution. In some cases, the cost overrun may cause abandonment of projects that government is supposed to undertake. So these are some of the implications for government and for individuals as well as businesses.
And for some experts as well, they say that perhaps what the central bank is doing is reacting naturally to the COVID economy, quote unquote. Do you sense that possibly the pandemic and the external shocks are having an impact on or influence on this decision that we're seeing from the Bank of Ghana?
If you can,
yes, I'm just talking about the external shocks, the COVID-19 pandemic and some other issues that are happening at the global level. The belief is that that's naturally influencing the decision of the central bank. In
reality, the policy position does not speak to that reality, because if you look at the monetary policy position, it has reversed all the kind of protection that they provided for credit, protection they provided for the banks. They have removed all that, which means they don't believe that there is COVID effect anymore to protect the market, to protect businesses. So we are going full as though we don't have any challenge on hand. So if you say that we are reacting to COVID, I read the Bank of Ghana's press statement, and they are trying to talk about supply constraint. The level of supply constraint that we had in 2020, we cannot be speaking about that now. So it is strange trying to emphasize that in their press release. But that is not reflected in the policy decision they have taken. The policy decision showed that everything is okay. All the benefits we gave you, we have removed all of them. You remember they removed the cash reserve position that they sent to 8%. They rather added up to 12% instead of bringing it back to 10%. So the policy position does not express what people are saying.
And in practical terms, give us a sense of this. How will this affect the ordinary Ghanaian, for instance?
Well, I look at the cost of borrowing or the lending rate that will go up as a cost to businesses. And depending on the strength, I expect that to translate into price determination, and that will fuel inflation. And already there are events that are to take place to fuel inflation, and this will strengthen it. And looking at Bank of Ghana's indicators that they look at, perhaps we may see another round of policy rate increase in the next window, and that will continue to create more challenges for businesses, more challenges for individuals, and that will go a long way to create problem for cost of living for average Ghanaian.
And generally, we know that even assessing loans itself is a difficult thing. So it appears that with an increase in this policy rate, that may worsen the situation. Access to credit has been a challenge here in Ghana.
Well, I indicated that earlier on, that if the increase in the interest rates is taking place in quick succession that we are seeing, then it gives signal to bankers and financial sector players that there is potential for defaults. So they need to be protecting their NPL. Therefore, they will be very strict with their credit policy and ensure that those that in their opinion are likely to repay will get access to credit. And that will be some of the implications for the banking sector and for individuals who want to access credit. So access to credit may become difficult to, especially new entrants, because you have to prove to be sure that this high rate you are able to pay. So that is what, that will be the challenge going forward.
And the projections going forward, is it looking good? The fact that, well, in a few days from now, the BOG giving some other factors may attempt to reduce the rate. Do you see that happening anytime soon?
I think unfortunately the BOG doesn't seem to accept the argument that perhaps they are misdiagnosing the problem. So their thinking is that when they restrict liquidity, then they will be solving the problem. But the auxiliary measures taken in addition to policy rate hike rather create more problems. So perhaps they need to revise the diagnosis they have made about the economy. The release already indicated that they expect inflation to go up again the next window. And there are other developments taking place. All those things will strengthen the increase. And as I indicated, perhaps the Bank of Ghana may be guided by the possible increase in inflation in the next window to hike the rate again. So we are actually operating within a cycle until other development take place. I do not think that in the short term we can run away from hike in inflation and hike in lending rates.
But you are the expert here, so help us out in terms of perhaps what you describe as a more optimum approach for the central bank to take. What should be that priority now for them?
Well, I think that when you are hiking rates, you need to appreciate that it caused some problems within the economy. And then the least that should happen is that even in the midst of the hike, there should be some flexibility for access to credit, for business activities to be going on. But what they have done, they have restricted the ability of the banks to transform deposits into various types of credits by increasing the cash reserve. I believe that they need to moderate on the cash reserve because it is hurting the economy. It is putting too much pressure on the banking system, and they are not able to deliver what they expect to do to provide the lifeblood for business activities to take place in the country. I also notice that there is some misalignment of the response in the banking sector. You have a treasury bill rate around almost 17%, but you will be surprised that some institutions are going to the bank to place their monies, and their monies are placed below treasury bill rates. It is disturbing. And the reason why that is happening is because the cost of raising or mobilizing funds for the financial system has become very, very expensive. And they are trying one way or the other to protect themselves. So while you are putting the cost of mobilizing funds for the banking sector high, the banking sector is also trying hard to ensure that they lower the rate they give to those who are placing money in order to make some difference. And that distortion is not good for the economy.
And indeed, looking at what it is that you've been telling us all this while, it appears there's a far-reaching effect on the economy, which is already set not to be in a good shape. So is that going to complicate the matters further and give a tough time to the managers of the economy?
That is so, exactly so. Especially when yesterday I had an encounter on another station with the Director of Research of the Bank of Ghana, and he indicated that the policy measures that they have taken would take 3 to 9 months to bear fruit, which means they are looking at almost a year-long pass-through effect before we can see any positive sign. So that alone should be a worrying statement from the Bank of Ghana that whatever they are doing, we are not going to see the benefit in the next 3 months. And then while they are expecting the first tranche of the policy measures taken to bear fruit in the next 3 to 9 months, other measures that they have taken is fueling inflation, and which means that the first expectation will not be met, and then more will be added to it. Then it will be elongating the period that the financial system, the market, should be seeing some positive result, and that is worrisome.
And from the perspective of a lot of globalists, they feel that this is the natural economy or business cycle that we're experiencing. Some way, somehow, the world will repair itself, including economies in the developing world such as Ghana. Do you subscribe to that view that we're just in a phase, we'll move out soon?
Well, I thought we shouldn't take that in absolute terms. It is true that globally, all economies are facing one challenge or the other. But the way you build your economy will determine the level of the effect or the severity of the effect. The structure of our economy as being built is not that strong enough to limit the effect on us. So that is the aspect I think we should be discussing. If you take US, UK, and the rest, and you say they are experiencing high levels of inflation, unprecedented over the last 40 years, that is no solution. The solution is, why will you be experiencing high food price inflation when you are producing those things in the country? That is the question we need to be asking ourselves. What do we do so that next time we will be able to give protection in such a way that even if we are experiencing high levels of imported inflation in certain areas, it can be accommodated by the level of lower inflation in domestic production, especially in the area of food. So that is what I believe we should be questioning. But to resign to what is happening to the global economy, that is happening here, is happening there, and for that matter, it's as if we should just accept it. It is not, a good sense of economic management. So we need to question our policies and the structure that we have built over time and see what we should do to the structure to be able to be resilient.
The details we are getting from the Statistical Service after the release of the inflationary figures appears to suggest that much of our problem has got to do with importation. So perhaps this may be the time to pursue some substitution, isn't it? What measures would you want to see from government in that regard?
Well, I wouldn't say substitution. It's just a clear failure of policy measures. Look, our economy, no matter what we are discussing, is largely agrarian. Therefore, put pen and paper down and count the number of agricultural related produce that we are importing into the country. That has nothing to do with substitute. That is where your strength is. That is what you should be doing anyway. You have failed to do that. So you should go back to how we should face agriculture. That is what we should be doing. That is where the problem is. We will import anyway, but our importation normally should be intermediate import that will feed our industries, especially for items that we don't have. I'm not sure we are consuming about 40% or 30% of produce in Ghana fruit juice. So what should we do about that? Value addition to our agricultural produce. So these are things I believe we should do. So we have run away from this. We should come back to them.
But then, government still has a lot to do in terms of shoring up export and also doing a lot more in terms of substitution. You agree?
Well, a lot needs to be done. Number one, we have not added enough value to our traditional commodities. In addition to that, we have not expanded our export destination in a manner that will give it the needed market access. That ought to be done. Then, when that is done, with the kind of support that is needed to those who are engaged in the production, I believe we can scale up. But that is what we are not able to do. Even when it comes to subsidy for our farmers, it is becoming a problem. When we know that there is a way of administering subsidy, and it's being administered in Europe, administered in America, and administered in Canada. But we speak as if subsidy is a no-go area because we are not willing to learn how we can deploy subsidy in a manner that will be beneficial to the economy, that will ensure lower prices of locally produced items, and that will ensure value addition in a robust manner to our export destinations. That is what we need to do. And it's as if we are not guided by this principle. We say we are doing industrialization, 1D, 1F. Majority of those businesses are just existing businesses We have not seen their activities in terms of export, value addition. We have Exim Bank. Basically, Exim is supposed to support critical imports into the country to feed our industry and to promote export diversification, value addition for export. The way we are administering Exim is questionable. We need to question all these things and reorient ourselves and refocus the policies. That is the only solution for us.
And just as we wrap up on this conversation, we know that government is in dire need of funding, and obviously it will not hesitate, for instance, if the opportunity presents itself, to mobilize revenue domestically. So giving this increment in the policy rate, is that likely to worsen our debt situation as well? Or, as you may say, that will be far-fetched?
Of course, the fiscal situation is part of the problem that we are seeing in high inflation and raise in the policy rate, and which will affect lending rates and other base rates in the country. And so the cycle continues. We have not broken the cycle yet. We've not gotten to that point. So they are feeding each other. Our debt level is still very high. Repayment constraints are still persisting, and therefore we cannot run away from the effect of debt burden on the economy. And what we are seeing right now is inability to assess or to get the needed revenue to do expenditure. So we are not actually doing much more expenditure right now. So whatever you see telling you that expenditure is being constrained is because we don't have the funds to spend. We are not spending as we ought to spend within the quarter because the funds are not just there. And we are seeing that to be constraining expenditure. I believe we should get to a point that fiscal measures should be seen as incentive for economic activity. And when that is done, the return for government in terms of revenue, it will be higher. But if government want to grab anything today, irrespective of the medium to long term economic difficulty that it will impose on businesses, then that becomes a problem. So I think it is time government should look at some expenditure measures, some fiscal measures as investment into the economy rather than being ready to take left and right. And that will constrain a lot of things.
All right then, Prof, I'm grateful that you've been able to spend some time with us here on the AM show. We wish you the very best of the day.
Thank you.
And thank you too for staying with us here on the AM show. We'll return shortly after this break.